Hello, investors. Welcome to monthly interaction with Canara Robeco. Uh, over next 10-15 minutes, we'll debate what are the global events which have been critical over last 1 month, and then we'll debate the domestic earnings season as well as the valuation and view. Let us start with the global piece first. Clearly, it has been an eventful month. You had flurry of actually trade deals that have been concluded by US with Japan, Europe, Vietnam, and some of the other countries. A lot of them, of course, clearly seem like the deals which are been done in a hurry, and they are to some degree one-sided. Having said that, clearly what has come out as a surprise is a higher tariff on India. The Given that India had started the trade negotiations much earlier than most of the other countries, clearly it was a negative surprise. The trade tariffs of 25% on India, along with that possible levies because of our procurement of Russian oil, looks like a tactical setback, at least to start with. Why we are saying tactical setback is because our sense still is that the trade negotiations are on. India doesn't want to get into a tactical deal, but a comprehensive deal, just like what we have done with UK and some of the other countries over last several years. And if we have to do a comprehensive deal, you need to take into consideration all the aspects. And one of the aspects that has been the problem point from India's perspective is whether we want to open up our agri and dairy sectors or not. And I think India is not keen to do that. Given that situation, our sense is for next 3-6 months, we'll still have a deal which will be different than the existing one, and we'll probably go have a tariff which will be closer to some of the peer countries. Having said that, in near term, clearly there is a pressure tactics that is being used by the US government. Now, with yesterday's new tariffs on some of our peer countries or our neighboring countries, India probably will have the highest tariff after China in the whole world. Even Bangladesh, Pakistan, Cambodia, Vietnam, Taiwan, everybody has been reduced below 25 level yesterday. So clearly, tactical negative. It would have ramifications in terms of several sectors, the industrials, auto, part of pharma, chemical value chain, textile value chain. Not all companies, but so few of the companies in some of these segments. Having said this, as I said earlier, also we think that this is a intermittent transitory phase, and we expect a full proof trade deal to be in place over next 1 or 2 quarters. This is the latest on tariff side. Clearly, the risk with the tariffs of 25%, which is a marginal disadvantage versus our peer countries, is that if it were to sustain for longer period, there are consensus expectations of GDP impact of anywhere between 25 to 50 basis point on India. That is one. Second is, if the friction accentuates, then you can have FII flows as a possible near-term risk for India. And third, given what the latest conversation have been from US side, you can have basically additional measures which might not be positive for India in the near term. But at the cost of repetition, again, we feel that this is largely a negotiation tactics to get a better deal. And to that extent, we think that over next 3-6 months, we'll have a comprehensive deal, which will not be as bad as it looks in terms of numbers. That's on the tariff side. Rest of the global events, I think, continue to be as they were. The geopolitics on Russia and Ukraine side, or the war on Russia Ukraine continues. Clearly the US administration has changed the side, and now they are backing the effectively Ukraine and Europe rather than being opposed to it. So there is quite to and fro and change of position from US side, and that's where the global environment remains complex. Key implications of this complexity is clearly that nobody is sure whether they should invest or not from a business, corporates, countries perspective, and to that extent, the trade growth will have a negative impact from these events. The commodities will have negative impact as a consequence. That is where we are, a complex environment, environment where the world is moving from unipolar world to multipolar world, trade deals which are becoming country specific rather than under WTO. And in this environment, one should expect a downward bias in growth globally. Coming to domestic side, I think domestic macros largely remain healthy, as we have been discussing the balance sheets. the inflation, trade deficit, fiscal deficit, every parameter that you can think of from a domestic macro perspective remains healthy. The challenge has been, and the challenge still remains, the cyclical slowdown in the earnings or growth that we have seen. The GDP growth rate has come down by a percentage point over last 4-5 quarters, and so has been the earnings growth. Financial year 25, the earnings growth was barely high single digit. As we have alluded in previous conversations, our sense is, with several factors turning around, one of the key factor was liquidity deficit in domestic market. Now we have surplus liquidity. Interest rate cuts have happened. RBI's administrative policy towards credit to unsecured piece of the market is gradually changing. You have monsoon, which is third year in a row, is good. You have governments, both state and central governments, actually spending or redistributing some of their spending towards the consumption or revenue expenditure, which is aiding the market. We're expecting 8 pay commission to come in sometimes. You have 1 lakh crore rupees of tax cut that center has done, and it should percolate into the economy. So you have several of the factors, basically, and you have government capex, which has come back from the lows of the election period. And so if you combine all those factors, our view still largely remains the same. The quarterly results are currently on. Almost probably two-thirds of the companies have reported numbers by now. The number sense is mixed, but largely along the expected line. There is no disappointment in terms of numbers. In terms of sectors, clearly banks at the margin, the larger banks, better NBFCs have surprised at the margin positively in terms of protecting NIM. But at the same time, credit cost at the margin has been a challenge across the board, barring probably 3 or 4 names in the sector. Across the board, credit cost has surprised negatively at the margin. So that's the largest sector, which is financials. Capital marketplace continue to deliver good numbers. Insurance companies continue to deliver good numbers. IT, which is among the again large sectors, the earnings growth remains muted, visibility remains muted. Then you have industrials and consumer discretionary, where the earnings have been largely along the expected line and healthy. Industrials had healthy earnings growth, particularly transmission and distribution, renewables, defense companies. All these companies have largely reported good numbers. So if I were to summarize the quarterly numbers, predominantly the trend continues. You have effectively consumer discretionary, part of financials, which is large financials, insurance, capital marketplace. You have pharma, you have telecom, you have aviation, you have hotels, you have hospitals, you have industrials, which continue to deliver more resilient or superior earnings growth as compared to spaces like uh, IT, as compared to the broader banking and NBFC space, tier 2, tier 3, as compared to basically the commodities companies, global commodities, as well as the FMCG space. In FMCG space, while the numbers continue to be bad, it looks like the numbers will turn around at some point in time. And that is the, I would say, more of a hope as at this point in time, and expectation at this point in time, as compared to any statistical evidence as of now. The all the FMCG companies reported weaker set of numbers even this quarter. So that's largely on the earnings side, high single digit earnings growth expectations. I think numbers are panning along those expectations. Given where the earnings are for next 2 years, by the consensus in terms of expectation, which is low double digit earnings growth, clearly the valuations, despite 3-4% market correction during last month, continue to be roughly at 20 times Nifty, and mid cap, small cap, which are trading at upwards of roughly 25 times. That's an expensive valuation to start with in the broader market. Probably large cap still remain expensive by 4-5%, but mid cap, small cap clearly are expensive. Within them, mid caps clearly stand out, because at least in that part of the market, the earnings are holding up well. The earnings relatively among the 3 asset classes are still the best. Mid cap, then large cap, and then small cap. This is the sequence in which the earnings are playing out. So clearly, the valuations are expensive, but the earnings are holding up better. Small cap is a space where clearly earnings are worrying. Last financial year was negative earnings growth. This quarter hasn't started on a very, very good note, and the valuations still remain expensive. So that is one part which we continue to see a disconnect between the valuation and the earnings. Large caps, along the expected line, earnings growth is playing out along the expected lines. And next year, you are going to have no drag from IT, FMCG, and financials. So to that extent, their earnings recovery largely will is probabilistically more likely to play out than not. So that's largely on the earnings side, valuation side. Given this context, given the additional risk from the tariffs, even if it is transient, which has come in, given the global complexities, given the global growth, which is weakening, and given the domestic valuations, which are relatively expensive as compared to the earnings context, which is there as of now, we expect market to digest the excesses of the valuations that have been done over last 2 years, uh, like what we have been doing since last September. So we see more of a consolidation for some time, till the time earnings actually trajectory improves to mid to high double digit from where it is as of now. So that's largely from our side on what has happened on equity side, both globally and domestically. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.